All right, let's go. So thank you everyone for coming. So my name is Guillaume, and I'm with Reflexo Labs. And today I'm gonna speak about what happens when control theory meets cryptoeconomics. And at Reflexo Lab we are building a new kind of stablecoins that involve control theory. So control theory is a widely known engineering field where it's about algorithmic control of dynamic systems and pretty much basically like the science of stability. So it's pretty good thing to when you want to build a stable coin. So like control theory is everywhere. It's in like probably all over this room. There are plenty of control theoretic systems, like from heating systems or like power supplies, and you have those controllers everywhere also in like industrial systems and so on and so on. And like the one typical example you have is like it's when you are in your shower and like you want the temperature, you want a certain temperature in your shower, so you turn the knob back and forth until you reach the desired temperature. So like the most elementary building blocks in control theory are PID controllers. If you studied engineering, you probably heard a lot about them. And like a PID controller takes an input and outputs a control variable to control your system. So it works by having three constants set, three terms: proportional, integral, and derivative. Proportional is just a constant that multiplies the input and gets the output. Integrals accumulate the error over time. So like if you are off your target for a longer period of time, it will accumulate and output a stronger signal. And last is the derivative. It's based on the rate of change of the error, and this allows you to address things like to anticipate the state of your system and to address like overshooting and things like that. This is a very simple example of like what a PID controller does. This is just a stick that mounted on a motor that tries to point to 45 degrees always, and you have a PID controller that like control this motor to get back to 45 degrees, and then someone comes with a stick and perturbate the things, and like after some times it gets back to like its targeted state, and it converges faster. Yeah, it converges fast to it, and like the key to tune the PID controller is like setting the three variables that I've talked to you in the previous slides. Okay, so like before we move on to crypto stuff, I wanted to point out this, this academic paper shows that like central bank policy like actually could be implemented or like are like PID control. And for example, this is with the Taylor rule, which express like the Fed funding rate as the regarding to the GDP growth, I think, and the rate of inflation. And this can be expressed as a PID control. And the same goes on for many of the most well-known and used in practice policy rules used by central bankers. So at Reflexo Lab, we are building Rai. Rai started out as a fork of MakerDAO's MCD, which is DAI, that probably most of you know. And there is one very key important difference, is that it has no fixed peg to $1. So it's free floating, and the peg is moving around. And the key to that is an algorithmic interest rate set by a PID controller. And the last important thing to note is that it's Ether-only collateral. So how that works, I want to define three things first. So the redemption price, the redemption rate, and the redemption rate feedback mechanism. So the redemption rate is the moving peg. Instead, like Makers has always $1, we have something that moves around. And like it's supposed to be the price at which Rai trades on the market. But it's also the price at which you will mint Rai. So like there is also like CDPs or Vault, or we call them safe. And like the redemption price is the price at which you mint you mint RAI. And it started as an arbitrary value. So when we launched it, we chose pi, so 3, 14, 16 something. And the next term I want to define is the redemption rate. So the redemption rate is the rate of change of the redemption price. It can be seen as an interest rate. And yeah, so for example, if the redemption rate is minus 10%, that means that the redemption price will go down 10% over a year. And last is the redemption rate feedback mechanism. It's this system with the PID controller that sets the redemption rate. So like the PID controller sets the redemption rate, which change the redemption price. So how does that work quickly? So on the top left, we have the market price in green and the redemption price in blue. So like the PID controllers sees the market. So the market is an AMM on Uniswap. And like it sees the error. So like, for example, the red arrow, like there is the current RAI price is like above the redemption price. And like the PID controller does his math and sets the redemption rate. And like, for example, here the redemption rate will be minus 11%. That means that the peg will go down 11% over a year. And then that way the redemption price goes down. And ideally, it is expected that this change in peg will affect the market, which will drive down the price of RAI. So what are the effects of like a moving peg or like changing this redemption price? From the perspective of RAI holder, it's pretty obvious. Like if the redemption price, the peg goes down, like you are entitled to sell or you would like to sell because you're losing money. And if the peg goes up, like you can buy and take advantage of this thing and make money. Like from the safe owner perspective, it's a bit more complicated. Like when the redemption price goes down, that means that their C ratio, their collateralization ratio is going up. So they can mint more RAI without taking more risk of getting liquidated. And therefore, like they can mint some more RAI, and this will likely put some pressure, price pressure, and like drive the price of RAI down. And like the opposite now, when the redemption price goes up, like it's bad for a safe holder kind of, because their C ratio goes down and they are at a greater risk of getting liquidated. So they need to buy RAI from the market and to repay a part of their debt to avoid liquidation. So this is, since they are buying from the market, this will likely push the price up. So there are of course other mechanisms that regulate the price of RAI. One is just arbitrage, people buying low, selling high, which is like the main like driver of the price on a daily basis. And like the redemption rate mechanism that we just discussed is like more on long-term thing. And yeah, so people can take advantage of the redemption price, either like when it's positive, you just hold RAI and you can earn like the interest rate. And when it's negative, you can just open it safe and your debt will melt according to the redemption rate. So we launched RAI in February 2021. At its peak, we saw 369 million in value lock, so Ether locked into the system, and more than 2,000 users positions, like those CDPs. And currently, like what we're seeing is that the price of RAI fluctuates around 2% of the redemption price, and now it has settled down. The redemption rate is below 10% annual. And so far, we've seen about 10 million, 11 million now, I believe, in liquidated collateral. This is the price chart of it since it's started. Like we can see that at the beginning it was pretty volatile, and like we also fine-tuned the controller since then. But like the price was a lot above the redemption price, which is in red. The redemption price in red. And like it drove the redemption price down, and nowadays we are more stable. And if we zoom in, so this is the last 2 months, we can see that currently the redemption price is the market price, sorry, in purple is a bit below the redemption price, and that's why we see a slight uptrend in the red curve. So yeah, the redemption price move fairly slowly and predictably, and the price volatility so far is good. This is the redemption rate since the beginning we've seen. So like, as I mentioned before, the market is a bit below, so the rate is positive, as we can see on the right side. And at the beginning, we had a lot of volatility and very high rates. But nowadays, it's like maybe 2-3% in a redemption rate. So, like, a question I get a lot is like, what's the long-term outlook of the redemption price, right? Like, where will it be in 1 year, 5 years, 100 years? Because that's something I care about if I want to store value in RAI, right? And like the very key factor to that is basically like if there are any large and sustained imbalances between supply and demand for RAI. And like the thing to keep in mind is that it's gonna move slowly, right? So it's first it's bounded. So like the redemption price, the peg is not gonna be like super volatile. It's gonna be something in the lines that we just saw in the previous charts. So why are we doing all this? And like what's the point? And like it's nice, but why? So like the thing to understand is that like with this kind of synthetic derivative asset like RAI or DAI, you want to match supply and demand. And what are those? So like supply is basically the RAI minters, so people looking in Ether to draw some RAI debt, and the demand, which are basically the RAI holders, like how much people are willing to hold RAI, or how much utility there is for RAI, so that people buy it. So what drives the supply? The supply pretty much depends on the appetite for leverage in the market. So like there are other reasons to mint RAI, but this is the main one. People that mint RAI are pretty much like long ETH, and they take a loan against this Ether to do something else with it. And yeah, questions? Sure, yeah, I can repeat.
I was just curious on the demand, why it's listed as the holders. Why is it not the converse? So like RAI withdrawers? Because in the supply, it's people who are coming into the system. And normally the demand is a complete opposite of supply.
Yeah, okay, yeah, good point. I mean, it could be flipped, but yeah, like from the perspective of like the RAI supply, I don't know, like there is demand, but yeah, you're saying that there could be like demand for leverage, and I don't know, I guess it's just a naming thing. Okay. Like, sorry if it's unconventional. Yeah, so, and the demands for RAI is just like depends upon the utility of stablecoins. And like what we observe is that these two things are unfortunately fairly independent, or if not inversely correlated, right? Because of the nature of the crypto market, like when you have a lot of like leverage into the system and people want to go long ETH, they don't want to hold on to stablecoins, and like when you have the bear market, people want to hold on to stablecoin, they don't want to leverage. So like it's not exactly true. Like in practice, we see that they are fairly independent mechanism that depends on different things. But this give a rough idea, and like the key is that they are independent. So like, what's the solution? The solution is to balance market forces, and that's exactly what the redemption rate is trying to do. One note: if you're a trader, you certainly know that longs pay short or short pays longs with those derivatives, and like this is exactly what the redemption rate is doing. So like when the redemption rate is positive, like CDP holders pay RAI holders, and when the rate is negative, like RAI holders effectively pay CDP owners. So I want to talk about Maker a little bit. So this chart, you've probably seen it elsewhere, is like the share of DAI that are backed by different collateral type, and the big one here is USDC, which is right now sits at about 60% of all the DAI in circulation. And it used to not always be the case. So like this chart is like like what's the share of USDC that backs DAI, and right now we are sitting at 60%. And yeah, so like it all started with Black Thursday, like in March 2020, when we had this big market crash, and to solve some issue regarding to the peg, like Maker introduced the first, like this USDC collateral took off for the first time. More recently, like in May this year, like the USDC backing DAI went all the way from 25% to 60% in a very short period of time. And this is due to the huge market crash we've seen in May, when Ether went from $4,000 to $2,000. And like what is important to see here, to understand here, is that this shows what I was pointing out before, that like when like the leverage into the system, into the market goes away, and that there is not enough people to go leverage long or long ETH, then there is not enough like DAI into circulation. So this has to be replaced by something else. And in the case of Maker, what is replacing that is USDC. Is more USDC collateral into the system. The last thing that we could wonder is like, what is this huge spike in around October 2020? So like at the time, Maker had problem with the peg. Like DAI was consistently trading above the peg. And to fix that, they like they lowered the collateralization ratio for USDC vaults from 120 to 101%, and that worked. That brought back the price of DAI to 1, but it had the consequence of driving a big influx of USDC into the system. So. Last, like why would I want to hold a coin that is supposed to be stable but not to $1 when what I want is $1? So like, yeah, it's maybe true, but like, I think it's pretty much impossible to do without introducing custodial risk into the system, and that's like the trade-off that Maker made, like a very hard peg over. Like introducing custodian collateral. So like flexible pegs allows you to effectively balance market forces and to have synthetic asset like RAI that is effectively only backed by ETH and still manage to stabilize itself. So can you explain more of the risk? Yeah, so is question, microphone coming?
Could you elaborate on the custodial risk that DAI has?
Yeah, so like USDC is a centralized stablecoin run by one single company, and like this exposes Maker to like a third-party risk, which is this bank account or like that is holding the coin, and like this ultimately rely at the end of the day that on whether Circle will always be willing to.
So I mean DAI, not USDC. Sorry, I mean DAI, not USDC, because there's no bank account with DAI.
Yeah. So, but what that means is that like if your one DAI is backed by 60% of USDC.
Sorry. Yes.
Is that like if USDC turns out to be worth 0, your DAI is turned out to be worth much less.
What about single collateral DAI when it was just backed by ETH?
So single collateral DAI was just backed by ETH, and in fact, what we're trying to do is much closer to what was single collateral DAI, yeah, and like, yeah, but the thing that we see, it worked at the time for sometimes pretty well. It was more volatile, but it was also more early. But yeah, like how would that work at scale? Like would that if it would have all the peg for so long and across all the market cycle? I'm not so sure. And yeah.
Okay, but just around the custodial risk you referred to is things like USDC backing DAI.
Exactly.
It doesn't apply if it's just single collateral backed by ETH.
Exactly, yeah.
Okay.
So like that's the trade-off you make. It's that they made. It's like they introduce collateral that is subject to counterparty risk. All right, so that's it for my talk. And yeah, if you have questions, like feel free to check out our Discord documentation. And yeah. Question?
Do you have any idea where, like, do you have an idea where demand for, like, which people are currently holding RAI? Because if you're getting like 2% interest essentially on it,
Yeah.
that's not a lot for a stable coin. So why, like, which
So-
entities are holding this?
I mean, obviously, like RAI is new, and like it's fair to like where is the demand coming from for this thing, right? Like it's all network effect. Like right now, there is a liquidity mining program, and people are mostly farming. So
Right, yeah.
that's where it comes from, mostly for now.
Right.
And like, but yeah, the idea is to transition to some more organic usage over time. So yeah, like RAI is on a bunch of lending platforms, and it's being integrated here and there, and yeah, slowly growing.
Yeah. No, I mean, I guess for most like stable coins that are new, it's
It's the same
it's
problem
the same
for
problem,
every
right?
new.
Like
Yeah,
they all have
yeah.
just demand because they have yield farms currently. There's
Exactly.
no, and I guess it's also like the biggest advantage of
Yeah.
Maker is that DAI is just integrated and actually used. And but
Yeah.
obviously you need something like this to
Yeah.
get hopefully to a stage where it's used.
So what's interesting about DAI is that like is the most commonly asset used in DeFi very often. Like when it comes to all these DeFi protocol, they choose DAI first. So there is a
Yeah.
lot of demand for DAI coming from there, and that's what has causing issue to Maker to hold the peg.
Yeah.
Like all this craze in DeFi summer and so on, and that's why they double down on USDC as collateral.
Yeah.
So
Like
yeah.
it's the only thing they could really do, I think,
Hmm?
unless they would just lose peg. And
Yeah, otherwise you need a way to get some
Yeah.
more DAI into circulation. Otherwise, you can't handle growth. So yeah,
and like I think it's pronounced Felley or something, like the
Yeah.
dollar stablecoin. That one is like $1 fixed, but I think it has a different mechanism to
yeah.
ensure it doesn't go
So like
over peg.
Fey is like a yeah, it's kind of like a bank or like I don't know, a hedge fund if you want so like that has like Ether collateral that back Fey, and they are they committed to like you can always redeem your Fey for $1 worth of collateral, and we will always be doing that. But yeah, it's a very different model because like they own all. I mean, the DAO, or I don't know exactly what the structure is there, has all of the collateral, and yeah, it's to be seen over time if they will be able to maintain like to have as much collateral as there is Fey into circulation, because since people can always redeem it, like yeah, it can be that people just redeem at the bottom of each price always, and that
Yeah.
the treasury goes down. But yeah, it's also an interesting experiment. And
But then if like demand for Fey is very high, so actually goes over peg, like do they then just like mint Fey and just use it to buy ETH to
Yeah.
collateralize?
that's what they
So it's
should do. Yeah,
like the same as like RAI would do it in RAI. It's like
Yeah.
other users will actually do this, opening a CPD and
Yeah.
Fey, like the protocol does it themselves.
yeah.
Oh, sorry. Yeah.
No, yeah. So like you're saying like when the price of Fey goes above, like the Fey protocol is selling out Fey for ETH, and like there is more ETH into the system.
Yeah.
But like same like what if like people are minting a lot of Fey at the market top, and then market goes down and people redeem? Like it can lose money.
No, for sure. Like I'm not saying
Yeah,
that
that's the
it's
thing.
better. I'm just like wondering if this is how it works, where, yeah, as you said, like
Mhm.
they
No,
do
yeah,
it themselves essentially.
exactly, yeah.
They'll try to maintain a peg themselves.
Yeah.
Okay, cool.
So they are the ultimate guarantee, or they guarantee the peg.
Yeah.
However they do it to smart contract or governance proposal or whatever.
Yeah. Okay. Interesting. Thank you.
Thanks.
Yeah, okay. This is a really dumb question because I'm not really into stable coins, but I keep seeing on Twitter people are part of homies. the 3.3, they're
Yeah.
also a stable coin, right? Do you mind